All right, welcome back. So I'm going to do something that I don't recommend doing, and that is to try and look at how things would have played out in hindsight. The only reason I don't recommend doing that is it's mentally very taxing, and it's obviously very annoying for me to view it based on like how you could have done versus what actually happened. But it is good to review trades and kind of learn. And then also I kind of wanted to go over how I approach these situations, and then how, if you've missed out on some type of situation you wanted to be involved in, how I would approach it. Again, I wouldn't follow what I'm doing. This is all for educational purposes. It's just a small portion of my capital. I'm just trying to give risk management examples. So if you don't know who I am, Ben Collins, CFA charter holder, Chief Investment Officer for Options Autopilot, which is an automated options trading platform. If you want to try that out or find out more info, check out the links below. We have a very good trial discount, so check that out. But what I did want to go over, and again, I would love to automate the long positions, and obviously we're working on that long term on how to approach these. But I don't necessarily like focusing on individual positions, but I do want to use them as examples of maybe what to do, what not to do, just from a risk management perspective and how I would approach it. So I do like to cover that, but ideally, the long term, we would basically be able to automate this, because I'm going to show that me being involved in the trade more so, I'm like too involved in terms of managing it, and it would have been better had I just let it go and not touched the position really, or had it mechanically been managed by the system. But we're still working out that logic and getting that into the program. So as of now, we're kind of just still doing the automated 111s. Those are still working very well. This is just what's currently open for the current contract. These are all automated positions right here. For automations total, up about $4,400. And then it's on roughly 25-ish thousand for this account. And so it's a good percentage return. And that's kind of, the more consistent trades. And then I'm also trying to augment that with some, long position directional trades and stuff like that. So that's where like the Intel, the RIVN, SOFI come in. Again, I wouldn't focus too much on the actual names that I was looking at, maybe just the approach. And again, don't follow anything I'm doing. I just want to kind of give lessons that I'm learning, and have learned over time, because this can get very frustrating. And it's weird to think, oh, you had a successful trade. Why are you frustrated? It's because even though it's probably a 200% return on the initial position, it could have been a 600% return, right? It could have been, I'm up $12,000 on, I'd say roughly a $5,000-ish initial position for Intel. Obviously nothing to complain about from that standpoint, but these are the scenarios where this is when you can like really make good returns, and why you would want to use options if you can not touch it and just like let it go. And I've long said that I kind of want to just have a couple positions that are just, long-term leaps, just calls, and they're just kind of strategic positions that I have opinions on, that I think will go up. And we've talked about it, and actually this is now played out, and it doesn't always happen this way. It's almost played out exactly as I've expected. It just has played out a lot quicker, and that's how it can happen. But that's how you make the big money, when you're right? We're trying to basically limit the losses when we're wrong. Obviously, you can see RIVN and SOFI, those are the times that we're wrong. So we're down, $4,500 roughly, but up 12,000 on Intel. That could be up 60, right? And that's the annoying thing, where you feel like you've left at least $30,000 to $40,000 on the table on a much smaller position. And I just wanted to kind of go back, because I was looking at some of my historical activity on Intel, just from the beginning of the year. So this was my initial, I believe, selling some out of the money puts. It's crazy to think I was selling the 35 strike put at $3.30. And then, I mean, we saw the chart. It's not like it was totally obvious this entire time, right? I was kind of trading in and out. It was actually up decently. Oh, this changed once I clicked it. Yes, but let me load this back up. And it did tread water for a very long time into April. So we can kind of see, since the beginning of the year, it did definitely increase from basically it did open around $40. And then it kind of like went along here for quite a while, built that base. And obviously it's been building a huge base for a very long time. It hasn't made a new high since 2000. But then it finally broke out here. And that was when I was, wanting to participate and did participate in general. And so I just want to kind of go over some of these things. I was in and out. And again, I was always kind of trying to make a convex position, whether I was selling puts, buying calls, and kind of rolling it up, right? So usually I'd buy out of the money calls, long dated. The stock would move basically at the money or in the money. I would kind of de-risk by rolling them. And I would only add to my position when I would get up on the position once I initiated, whether it was a new position or my initial position. So beginning of the year, if we just look at this is when I sold these. I was already long them, I believe, at the end of the year, but 45 strike call, right? So a July 2026 45 call for $7.75. Let's go and look what a July 17th, 2026 call is at the 45 strike now. So remember, $7.70, $64, right? So basically a 9x return had I not touched it, and just kind of put it out there, limited my risk, said, well, it's either going to be a zero, it could be decent return, right? And we could kind of make that argument for a bunch of the other positions that I rolled up. And so that's what's detrimental about maybe being overly active. And again, if I was not seeing this and it was just mechanically going in the background, this would be how I'd probably manage things, manage risk. But it would be a lot easier to take risk when it's just mechanically getting applied. And that's where we want to add this in, because it just kind of takes you out of there. You have your initial idea, and then it will like progressively manage the position, right? So we were in and out of it, and you can kind of see, throughout the year, April's when it finally broke out. I'm just trying to get my bearings on when I would have like managed some of these positions. Yeah. So I basically was taking some smaller winners. I was trying to say, yeah. So that's kind of insane. So anyways, the point being, like, I basically, limited my upside into earnings, which again, I'm typically fine not leaning too far one direction to earnings, because you just never know. It's such a coin flip. But like I said, it felt like maybe there could be an outsized move, but I had already kind of hedged myself, and I had pulled one back off. So I was basically long one extra contract. Now, again, in hindsight, had I just let that one contract go, I probably would have been up another $2,500. But the tough thing is when you get a gap and go like this, I mean, this is when you would have made your money, right? And imagine I had been holding just from April. So that's 50 to 108. That's $60 right there. So again, it probably would have gone from a $13, $14 into a $70, $75 call premium. So right there, you're getting a 4 to 5x return on your position, and that is why we want to trade options on the long side. If we can get those right, even if it's 50% of the time, if we're managing our risk correctly, it should work out well. But these are the type of moves you stick around for and you want to trade, but you need to be involved. And that's where it's like, if you're long the stock, it's pretty easy to just be long stock. You don't have to do much management, right? Even if you're long the stock here and you kind of hedge with some calls, you'd probably be kicking yourself because it was such a big move. But now it's just relentless, right? And I don't think it's technically done. I would love to get kind of a big downdraft pullback. As of right now, I sold a few puts a few days ago. You can see I'm up on those. But, again, I was just trying to hopefully leg back into a convex position where I'm selling puts and then buying a call spread or buying calls again. but the move, it just keeps going, right? And the market's going to do what it's going to do regardless of, my opinion, your opinion, anyone's opinion. All we can do is manage the risk around those things. But it does get frustrating to feel like, okay, you could have made $50,000 on a very small position. That's obviously a benefit of options. It doesn't normally happen, so I wouldn't encourage that type of position or, I guess, hope. So, but you do want to have a good way of managing it. I'm just trying to point out being involved from an emotional standpoint, capital standpoint, and trying to manage them. You end up micromanaging a lot of times and doing some unnecessary things. So, in this scenario, if I could have just mechanically put profit targets and stop losses and just kind of let it go, similar to the automation we have on the income trades, likely would produce significant returns in the long run based on these types of moves, right? And I have those parameters that I would want to add in terms of how it's finding them. Obviously, that's going to be proprietary to us in our platform. So definitely stay tuned and check out Options Autopilot. But yeah, I kind of wanted to go over that and kind of the detrimental thing. But the tough thing is usually like once this move happens, it's like, okay, well, what do I do now? You're basically in this position like me. Like you feel a little bit annoyed and kind of hopeless. You're like, well, crap, missed that. It's gotten away from me. I'm just going to wait. But as you wait, it might be doing exactly what it's doing, right? It just keeps gapping up. New, better news, good news comes out, and it just keeps moving higher without you. And then you're like, man, that really sucks. So the only thing I would say, and my plan kind of from here is just like what I was talking about, right? I would love to keep getting some pullback to sell some more puts. Again, I'm going shorter term. You can see that the IB rank is basically at 100%, which is interesting because I was going to note that after earnings, the volatility did not really crush that much in terms of the IB rank as well. It stayed pretty elevated again because I think a lot of people were just buying upside exposure by calls. And so this is a scenario where, okay, I can get pretty decent premium selling some puts out of the money, and I would be fine owning the stock here as well, right? So it's one of those things where I'd be fine taking a position if I got a sign, but for the most part, what I'm kind of doing is selling to finance my long, right? And I'm already up 12,000, so I could use a lot of that capital. But what I'd like to do, because it is so extended, and there's no guarantee that it would pull back, but usually if it gets extended, you'll get some type of profit taking, some kind of pullback. So I'm looking to take advantage of that, and I will probably be systematically selling some puts. The tough thing is if it doesn't ever pull back, I'll probably be, kind of selling either more of the same strike or maybe a little bit up at 70 because, it basically gapped to a brand new high, all-time high, right? So higher than it ever was even in the 2000s. So my guess is that is kind of a new level, right? People kind of psychologically in a lot of algorithmic systems will say, okay, well, fundamentally things have shifted. People are willing now to own it above a previous all-time high. Now that should be the support where people now view maybe $70 as a deal, quote unquote, a deal to buy Intel at that price based on the prospects that it has now. So that becomes sort of the floor, and what I'm kind of betting is that it doesn't go under there, right? But I'm getting the premium in the meantime. I'm able to sort of participate, obviously not as much as you'd want. And then I would potentially be, because volatility is so elevated here, I would probably be buying a call spread and probably longer term. But it gets tough now because of, and this is the tough thing you have to understand about options is, when volatility gets elevated, you have to judge where you think the stock is truly going to go from a fundamental or a technical standpoint and what the value is going to be, and then compare it to buying just outright calls or a spread. And as an example, if we looked at, if I bought a 110, 130 call spread, that cost me, let's say, roughly $7 or 6. So 6 into 20 Sure, that's a 3x return ultimately on your initial investment. Nothing very, that's very good, right? If you just let that go. Um, but not as crazy as if you could obviously get a move from 60 to 110, right? And have it turn into a 6 or 7x, sometimes a 10x. So that's the kind of trade-off you would want to be kind of considering there. Some of the stuff is just getting so crazy. In certain elements, if you have enough capital, it might make sense to buy the stock, sell the call, because volatility is just so elevated, and then you can participate that way with a little, some limited upside. But that's kind of what I'm looking at here. If you kind of look at, again, all the implied volatilities right here, percentage-wise, pretty elevated. Obviously, it's going to decline as you go farther out in time. What's interesting is they're not really having longer dated options on Intel. On SoFi, they have, I think, 3 years or roughly 3 years out. On Intel, they only have about, well, not even 2 years out. So I'm assuming the market makers are doing that for a reason, because there's so much exposure for them, because people are just wanting, upside exposure, right? That's what makes me a little bit concerned. Again, the market's going to do it. If the big money is going to buy the stocks, it's going to push it up. But there's just a lot of exposure via derivatives. So I think it's possible that a lot of people could get sucked into buying a bunch of calls, and then they take it the other way. Again, not a conspiracy theorist, but that's just how it can then get balanced out, and then that drops the premiums on these calls. But as an example, if you're buying this 150 strike call, almost 2 years out, I guess, well, 1.5, then, well, yeah, almost 2. You're basically betting by expiration that this would be at $181. So it's like, do you think it's going to go from 110 to 180? Definitely possible if this continues, but you gotta balance that out. Like, sure, it'll still gain value if it moved quickly in the meantime from 110 and up. Obviously, the delta is 57, which, again, you got to understand how crazy it is. Usually, deltas are at 0.5, right at the money. So this is kind of just highlighting the demand / imbalance and the cost of holding the stock versus holding options. And that's why the delta shows as like 57 out here. So theoretically, it should move at half or 0.6 of the stock roughly, even if it did move up. But because volatility is so high, as it's decaying, it's not actually going to move like that. So things that, if you're not sure, definitely watch some courses. We have a course on options autopilot about options and volatility in general, and how those things work. But again, those are things you have to keep in mind when you're just directionally trading. Again, you could sell some puts to finance some of these long positions, and my guess is a lot of funds are doing just that themselves, because you can get a decent premium even on a 60 strike put, right? A couple years out. So if you really think the stock is now fundamentally not going to go below $60, you can get quite a bit of premium here. Not a ton of theta, but you're definitely getting some theta to hold it, and depending on how much margin you want to use, you could get a pretty decent return. I think, let's say if we just give this as an example, just to be thorough, let's say we're getting $980 if we sell one of these contracts, and we're only using $652 in margin. That's actually basically 150% return on our risk, right? A margin at risk. So obviously you need to consider the actual max loss and the fact that you could lose more than that, but just the initial buying power, that's a pretty good return, even if literally the stock sat there and didn't go down or didn't really appreciate from here. You're getting a very high rate of return on your margin. So that, combined with maybe a directional long, is why it can make sense to speculate or kind of take some limited risk positions from that standpoint. So I just wanted to kind of cover that. Obviously, the market seems to want to go higher, and the market will do whatever it's going to do And a lot of people will say, you know, it's going to inflict the damage on the most people. So if people don't understand or don't think the market's going to go up, that probably means it probably will still go up. Again, it's not like it really knows, but you know, you climb the wall of worry and slide down the slope of hope and all the other kind of fun sayings that come along with the stock market. But definitely seems like the market is wanting to go higher. I might even, and as soon as I do this, I'll probably fall. I might even pull off my longer term hedge just because it's obviously just kind of bleeding at this point. Maybe I'll roll it up or adjust it, but it's seemingly probably not going to get to, you know, the 6,200 level unless something really drastic were to happen. And my positions on MES are scattered enough in terms of like position size enough to where it won't individually hurt me if they all kind of went to zero, or I guess I got stopped out of all of them initially at this point. And then again, the automations will just keep running and keep putting positions on. So it should work out over time. So those are my thoughts. I'm not going to go over RIVN and SOFI. I guess the only briefly thing I'll say is that I cut a couple contracts on SOFI after earnings because it did kind of fall and looked like it was violating that trend line. And there is one other kind of point line in the sand, so to speak, where I would cut the whole position. So it's possible I'll end up cutting this entire position, which is, I mean, it doesn't really matter. It's not, I shouldn't say disappointing, but it's one of those things where I think it's got a lot of potential. Like it's still on this trend line, but if it basically makes a new low, breaks down below this, I will exit. But stay tuned for that. And then Rivian's just another kind of sitting around, not doing much in general. And I was actually up again on these positions initially, and then they've now come back off, and I'm, you know, down. P&L open is down. So I was almost back to break even on one of them, and then now it's kind of giving it up. So that's the name of the game. It can happen. Not everything is going to be like Intel, but this is why we kind of have to manage. We want to manage these to hopefully stick it out to be able to get the Intel type returns. Doesn't matter what it is. I think there's some other ones that could be. I've talked about Google. That's already kind of broken out. I think that could continue. So I might look to kind of structure some positions around there and some other ones. So definitely stay tuned, subscribe. If you appreciate the transparency, give it a like, share it with somebody that this might be helpful for, who might be looking at Intel or wondering just in general. Again, I don't want to make it specific to a position, more about risk management and maybe how to approach these things if they feel like they've gotten away from you, and how to kind of just manage your risk around these. So appreciate everyone watching, and remember, always manage the risk out there. Check out Options Autopilot, and you got to live to trade another day. And I will talk to you in the next one. Have a good one.